I don't believe we're in a bubble, but I would like to start by saying I've got a tremendous amount of respect for Peter. He made a great call back in 2006 on the housing bubble. So I'm very interested in what he has to say because I'm not a perma bull. I'm very interested in shorting overhyped, overvalued stocks. Recently, we've made short calls on stocks like GoPro and Tesla. And just for the record, any stock I mention now is just for the purposes of conversation, is not a recommendation long or short. And back when the 3D companies were getting overhyped, I warned people about them. So I'm very, very interested to hear what Peter has to say, because I don't believe that we are in a bubble, and I think that the fundamentals bear that out.
There I was thinking we're going to get a sort of a brisk debate getting underway here and get our verbal punching gloves out there. So let's now get Peter Schiff on the conversation. There you heard it there, Peter. I mean, Wayne has great respect for you because you pointed out the housing bubble back then. Are you seeing any parallels between the 2000 and what we're in right now in terms of a tech bubble?
Well, I do see a lot of parallels, and I appreciate the comments from Wayne. But, this time around, the difference is it's not really a tech bubble. It's just the entire U.S. economy is one gigantic bubble, and that's what makes it that much more frightening for the economy and for investors. And, remember, within a year of the Nasdaq first getting above 5,000, it dropped 4,000 points. I mean, we had an 80% decline. And so people need to be cognizant of the risks when you get into the markets at these levels. But I believe the real threat is that the underlying economy, I think, in the United States has never been this weak. And I believe that the Fed is going to be more desperate now than it was back in the early 2000s to try to contain this bubble, to try to prevent it from popping. And so we might not see the same type of carnage we saw in the stock market. The carnage might be reserved for the foreign exchange market, for the dollar, because they're going to have to print a lot of money to try to stop this bubble from bursting.
But the thing is, Peter, if you take a look at what happened back in 2000 in terms of technology stocks rallying, and Paulie and I were talking about this at the beginning of the program, the shape and path of tech bubble were completely different companies. We did not have the world of Internet of Things. We've completely disrupted industries here with the new types of companies. Do you really see the same situation here? Because it's a different path in how the Nasdaq has actually formed its path to into this territory of 5,000.
Look, it's never exactly the same, but whenever there's a bubble, it's always different this time. There's always reasons to rationalize why it's different. Remember, that's exactly what everybody was doing in 1999, 2000. They were rationalizing why it was a new era. It was a new economy. So you always feel like this in a bubble. But if you look at what the Fed has done to prop this market up, the Nasdaq wouldn't be here. But were it not for QE. It wouldn't be here without 0% interest rates. It wouldn't be here without unprecedented stock buybacks fueled by cheap money. You have all these artificial props that have lifted up the market, and there's no way to sustain the market without those props. The Fed is talking about normalizing interest rates, shrinking its balance sheet. It can't do that without pricking this bubble and collapsing the market. Now, maybe they won't do that. Maybe they're going to launch QE4. That's what I think they're going to do. And maybe the market won't collapse. But when that happens, the dollar will, because the dollar is being propped up by the idea that the Fed's going to hike rates.
Wayne, we're going to jump on that theme of liquidity. Sorry, Peter, we're going to jump on that theme. And Wayne, I want you to weigh in on this, because I want to get your take on late-stage funding for some of these pre-IPO companies, because when you look at the top deals from 2014, 4 out of the 5, according to PricewaterhouseCoopers and the National Venture Capital Association, 4 out of the 5 top deals are tech companies, the number one being Uber, being funded with late-stage capital of $2.4 billion. Are you worried that there's just too much momentum going into some of these companies with, for example, Uber valued at $40 billion at the moment, and this is causing part of that, what people are concerned about, creating this bubble?
I think that's a great issue. These are, pre-IPO situations. Investors need to know what they're doing before, they get involved. but some of them have very disruptive technology, and they're going to be tremendous companies like Palantir, for example. But I'd like to get back to something that Peter said, because I'd like to make a comparison between the tech sector now and what the tech sector was. I think there's almost no comparison. And if you don't mind, I've just got a couple of notes here. So back in 2000, the PE of the tech sector was what? 99, 100, 200. So you know your equity yield was negligible, almost zero. Today, if I use the information technology sector, you know, the S&P 500 has 10 sectors. Information technology sector, the PE is 19.6. So I've got an equity yield of 5.1%. I've got a free cash flow yield of 6.1%. The semiconductor index, which semiconductors are the heart of what's going on right now in technology, the dividend yield is 2.1%. That's above where the 10-year note yield is. And even the S&P, if Peter wants to broaden this and go to the S&P, the dividend yield of the S&P is 1.95.
Yeah, well,
there's never been a time, Peter, please let me finish.
Yeah.
There's never been a time when, if you invested, when the dividend yield of stocks was higher than the 10-year note yield, that you didn't do well over time. There's just, you know, so you've got back in 2000, you had no free cash flow yield, no dividend yield, and no equity yield. And the, you know, one of the few other assets that's actually as bad as that is gold, which also has no yields. I know Peter is a big gold bull.
But we've never had a period of time where you've had 5 or 6 years of 0% interest rates. You've never had a period of time where you've had the Fed expand its balance sheet to the extent that it has. The U.S. economy is on top of an enormous bubble, and that bubble bursting is going to impact the stock market. In fact, raising the stock market was part of the Fed's antidote for what it believed was sickening the economy. The Fed deliberately inflated bubbles in the stock market and the real estate market. Now, sure, in the tech world, tech is not as overvalued relative to the rest of the market as it was in 2000, but that doesn't mean it's not a bubble in the stock market. And of course, a lot of these companies that are considered tech, I mean, you mentioned Uber. Uber's not a technology company. I mean, it's a ride-sharing company. It uses the internet, but I don't think it's a technology company. And I think the valuation is absurd. And there's a lot of companies like Uber that are sporting these absurd billion-dollar market caps. Many of these companies haven't made any money. Many of them won't make any money. And it's very reminiscent of what was going on during the 1999, 2000 dot-com bubble. Yes, there are good companies that I think are still overpriced relative to the Fed. But what's going to happen to all that free cash flow when interest rates go up? What's going to happen to all that free cash flow when companies have to start servicing this enormous debt that they've taken on during the bubble?
Go ahead, Wayne.
Yeah, go ahead, Wayne. Weigh in.
Okay. Peter, you might have a different job than I have. My job is to help the clients of the firm place their assets where it's going to do them good. So I know you've been bearish on this and talking about a bubble for quite a long time. So just even recently, we've had big winners in stocks like Avago that I recommended on this show a month ago at 106. Right now it's 130. Stocks like NXPI, which has amazing technology where cars are going to communicate with each other and even communicate with the infrastructure on the roads. Stocks like Dexcom, where you're going to be able to have glucose monitoring hooked up to your cell phone so that parents of kids who have that problem will get alerted right away. So are you saying we shouldn't have been buying these stocks and making profits for our clients? When it starts to go the other way, we will play it that way. So again, I think my job seems like it's different than yours. Your job seems to be making big macro calls, but keeping people away from assets that are making them money.
Well, if you can keep those profits and go the other way, then I'll be a big fan of yours. I just recall the late 1990s. I didn't buy any of those dot-com stocks. I stayed away from all those bubble names, and people made fun of me in 1998, 1999, because my clients weren't making money. I wasn't making any money. But when the market got cut in half in 2000. And when the Nasdaq dropped 80%, we had a fantastic year, and we went on to make tremendous returns for 8 years in a row. The stocks that I was buying in the late 1990s that nobody wanted, many of them went up 10 or 20-fold in the ensuing 8 years. Most of the people that didn't, that were in the Nasdaq
and it's my
bubble
job to,
didn't
at that
sell,
point,
and they
find
got
those
wiped
same
out.
stocks.
So,
But
right.
Peter, let me just
look, if you
Peter,
can do
let me
that,
just
my
read a
experience
tweet.
is that you never get out of the bubble. Yeah.
Okay,
Okay,
Peter,
fair
let me
enough.
just read a tweet from downtown Josh Brown, who makes a comparison to what the tech picture looks like today compared to 15 years ago. He says things that didn't exist the last time the Nasdaq traded over 5,000 was Google, Facebook, Twitter, iPhones, Teslas, iPads, Kanye West.
Which is the point I was trying to make as well.
But yeah, the point that he's trying to make, and Adam, is that
Exactly.
things are different now, and some of these companies that have cropped up since 2000 have done quite well.
Yes. Yes. It is always different this time. There's never a bubble where it isn't different this time. That's how bubbles work. And that's the one thing that they all have in common, that everybody says it's different this time. And, my experience, again, is that bubbles always make you choose. Either you're going to look like a fool before they pop, or you're going to look like a fool after they pop. I have
Peter,
always looked
there's
like
fundamentals
a fool
here. I
before they
just
pop.
went over
But
these
I think
fundamentals
if you look
with
like
you.
a fool before they pop, you end up making money. What?
Are you saying you won't buy? Are you saying you won't buy a stock with a
What's your point?
6% cash flow? Are you saying you won't buy a stock with a free cash flow yield of 6%, with increasing operating earnings, increasing EBIT, with a growth rate? How would you not buy an asset like that?
We are buying plenty of stocks that have great fundamentals, much better than the fundamentals of the broad U.S. market. We're getting better valuations, better growth rate, higher dividend rates, but those stocks are just not going up every day.
So then there's no bubble.
They're in other countries and they're in
All
other
right.
currencies, right? No,
We need
here.
another hour
I'm talking
for
about
this.
here in the United States, and the bubble encompasses the entirety of our economy. That's how this bubble is too big to pop.
All right, gentlemen. Look, this has been a fantastic conversation and great debate on whether we have a bubble in the Nasdaq right now. We've got to leave it there because we're going to be running into this hard break. We really want to say thank you to both of you for joining us to flesh out those very details, and certainly be very interesting for the viewers. And right now, as I speak, we're getting a lot of responses on Twitter, so it's been fantastic. We're going to say goodbye to you, gentlemen. Thank you very much. There's Wayne Kaufman of Phoenix Financial Services, and of course Peter Schiff from Euro Pacific Capital, talking to us about whether we really are in that tech bubble. And that